talking about work that's being done on thinking about misallocation of resources and its implications for aggregate productivity. So since I work heavily in this area, I wanted to like pass on some things I think we've learned and some big open questions that there's room to work on. So let me start by saying, you know, one thing I've encountered in teaching is people like, what exactly is misallocation? And I don't think there's a standard definition, so I'll just offer one here. And it's basically saying, imagine that the government could feasibly implement taxes on some firms, activities, workers. It could be an activity like R&D, or could be certain types of firms or certain types of plants. It could implement taxes on one and subsidies on others to induce a reallocation of inputs like capital and labor across some firms or activities and others. If in doing so, that would raise, I decided to say raise welfare. And then the question is, whose welfare? So let's say a representative agent, so a fictional representative agent. So some of this is just like all of what economics is about, which is the efficiency of allocation of resources. You could say a lot of economics, though, is taking into account heterogeneity and welfare outcomes, too. So that's not quite fair. But the reason I want to emphasize this, first of all, it's very broad, but the reason I want to emphasize this is because occasionally some people will talk about misallocation in response to things like information asymmetries or things like transportation costs. But so if the government could not implement something based on what it observes, its information, or for example, it can't reduce transportation costs, then the fact that there's a high rate of return to one activity somewhere relative to another place isn't misallocation if you can't really feasibly move those resources from the low marginal product to the high marginal product activity. Anyway, so I wanted to get that definition out there. The aim is for things that a government could do or could cease to do that it's currently doing that could increase something like welfare in an aggregate sense. If there's misallocation, if the government leaves something on the table where it could improve things. Okay, so to fix concepts, I'm just trying to boil it down to the simplest possible model. So this is going to be a static model with just like CES aggregation of different products. So the YIs are different products. There's a fixed number of products, M, that's part of keeping it simple. There's an elasticity of substitution, sigma, that's greater than 1. So that's the CES aggregate. And picture these individual firms or products are just linear production and labor. So labor is the only factor of production here. And then picture a firm is just maximizing static profits, which it's going to take wages as given. It's going to take an aggregate price index as given. It's going to take this tax that it faces. Think of it as tax just for the moment here. Think of it facing a revenue tax. And it's going to take these big objects like the wage, the aggregate output, and the price is given, and it's going to choose its only choice variable, this price, to maximize these net of tax profits. And picture, just to keep things simple, there's just labor is the only resource, like I said, and it's allocated across these different products or firms or plants or what have you, or farms for that matter. And exogenously fixed total labor and exogenously fixed number of varieties. So the only resource decision here, the only allocation decision is how do you allocate these LIs? Okay, so now one thought you might have is what the heck are these taxes? Why are you talking about them? Why are they I specific? That's what a lot of what I'm talking about in this concept portion is about, is like what could generate dispersion and what's like a tax rate across firms. So if you look at the firm's first order condition for setting its profit maximizing price, it sets its price as a markup above its marginal cost, and the marginal cost is just the wage relative to its efficiency. So this AI here is like a process efficiency variable. So so it would normally just set it equal to a markup above that, and because everybody faces the same elasticity of demand, the markup would be the same for everybody. But because of this revenue tax, that's like an additional source of marking up their costs. So one thing to point out right away is that markup dispersion would show up as a tau I here. And then you can ask, if you try to measure productivity differences across firms, the kind of traditional way to do it is to look at something like revenue of the firm divided by some measure of its inputs. So here in this model, let's call that, this is a terminology coined by Foster, Haltwanger, and Severson, is to distinguish TFPR, so not TFP, not total factor productivity, but revenue TFP, to emphasize the fact that you've got revenue here, not some real output measure in this numerator. What's fascinating here is that this revenue productivity does not reflect efficiency, underlying process efficiency at all in this simple model. Instead, it reflects entirely these tax rate wedges or these markup dispersion, for example. And so that doesn't reflect efficiency at all. So I'll return to that in a little bit, but just to keep emphasizing the misallocation thing. In this simple economy, then we would say, there's a representative consumer with these preferences here. And then all they care about is getting a lot of output for their fixed labor endowment that they collectively provide to the economy. And this is the expression for aggregate TFP in this economy. And the socially optimal thing to do is to set all these tau i's to some common level. And actually the common level in this static model doesn't matter. So the efficient thing is to allocate more labor to the high AI firms, not all of it. The max AI firms shouldn't get all the resources in the economy because of these diminishing returns. Because this exponent, if we go back to the original production function, sigma is greater than 1, so this exponent is less than 1. So there's diminishing marginal utility to any particular product, so the social planner wants to allocate more L to the high AI firms, but not all of it. There's an optimal allocation. Okay, and the optimal allocation has an elasticity of labor with respect to AI of sigma minus 1, and that's what produces this aggregate TFP that doesn't involve labor, but endogenously builds in this optimal allocation. So relative to this optimal allocation, these taus are like sand in the gears, that they're mucking up the market's efficient allocation of resources. And you can't stare at this and see it very transparently, so I like to use the log normal case. Imagine that A's, these efficiency levels, and these, you could call them markups, you could call them idiosyncratic taxes and subsidies, if they were distributed log normally across firms with certain means and variances, then the log of aggregate TFP could be expressed as the mean of the log of these productivities they draw. There'd be a positive term because dispersion, sigma squared A, dispersion in these AI's is good because the planner can allocate more labor to the high AI firms. So they kind of like dispersion, mean preserving the spread in productivities to the extent that sigma is greater than 1, and they can take advantage of that. But here's the misallocation term over here. This is this sand in the gears, this variation in these taus, like variation in markups or taxes, is misallocating resources. And you can see it's doing that, it's subtracting from aggregate TFP, the more this variance and the higher sigma. Because when sigma is high, labor is responding more elastically to these tax rate wedges or markup wedges and misallocating labor more. So this is just a nice expression to see what the fundamental forces are behind that. So there's two other things here. Notice the mean of tau doesn't matter. In this static economy, that doesn't affect anything. And the other thing that's kind of surprising is that what's the covariance of these things? It turns out the covariance doesn't matter at all between tau and A, but that's a special property of log normal, so I don't want to emphasize that too much. Okay, so what are some lessons we get from this model? If you call these taus wedges, one is what I already said, which is if you measure revenue productivity, keep in mind that isn't the same as process efficiency. That could instead be a distortion that you don't like rather than efficiency, which you do like. They could have in practice be correlated. I'm going to argue later that there's some evidence they are very positively correlated. But that's one key conceptual thing to keep in mind, that those are not the same thing. Aggregate TFP is decreasing in the dispersion of these wedges. That's misallocation. And if you just look at it this way, you can imagine a data set where you had a measure of this variance and you had an estimate of this elasticity, and you could get like an aggregate productivity loss. And when I show you some data, I'm going to argue this number can be quite big. So it could be easily, output is half what it could be if you had an efficient allocation of resources, at least if you take the data on this TFPR dispersion at face value. Okay, so that's a lesson. I already mentioned the mean wedge point, already mentioned the dispersion, so let me move on. Okay, so more on TFPQ. How do you get it if you have revenue data? Well, if you knew this elasticity of demand, you can actually back out. It's like saying if I knew where I am in the demand curve and I knew the slope of the demand curve, I can kind of back out the price and therefore back out the effective price and therefore back out effective output. But it's important to keep in mind that this output here is not just quantity, but anything affecting effective demand. So that matters because then if you construct TFPQ as some measure of backed out output relative to inputs, it's not just process efficiency, you also have quality and variety. And I emphasize this because one of the things the literature is, I think, sometimes really clear on and sometimes could be clearer on is that they'll sometimes say, well, we don't have physical quantities, so we can't construct TFPQ. But TFPQ, if you think about it, this already has some measure of quantity, quality wrapped up in it when you calculate it this way. If you did have a data set with physical quantity measures, then you can measure physical quantity relative to inputs. But that, although interesting, isn't interesting entirely on its own. Like, who cares how many units of something a firm can produce if those units are lousy, if nobody likes those units, if their quality is something that's not appealing at all. So the composite of this is arguably more meaningful than some measure of physical quantity per output. But you can back out quality and variety separately from process efficiency by taking the ratio of those. So that's just a constructive thing you can do with the data. If you don't have unit prices, you can just back out something proportional to output this way, get this broad measure of TFPQ. If you do have physical quantities on top of that, then you can back out process efficiency and something about effective quality separately, which can be useful. Okay, I took the simplest possible model, but there's a lot of different directions you could go that people have already gone to that are easy to generalize this. You can add inputs like physical capital and intermediates. You can put wedges, not just on revenue, but on all the inputs. You can think about overhead costs and entry costs, and people have done that. There's harder things to generalize because they involve dynamic decisions or more nonlinearities. So things like financial frictions that that are a function of obviously involve capital, so dynamic decision there. Adjustment costs to varying things like the capital stock, but people have pursued that. You can also think about the CES with monopolistic competition is special. It leads to constant markups. But if you have things like a variable elasticity of substitution, or for that matter, non-monopolistic competition, you can get dispersion in markups. So I'll return to that issue, even though I've touched on it, that markup dispersion can be a source of misallocation. There's some really nice work, like this recent paper by Bakai and Farhi, that generalizes to an arbitrary input-output structure and even different returns to scale, which is really nice and useful. And then you can think about, well, the TFPQ might be endogenously a function of these wedges firms face, like their markup behavior that induces firms to innovate, but the dispersion in it could be a good or bad thing for how it affects the allocation of research and innovation, for example, or for that matter, the quality of firms when they enter. Okay, so one thing that I touched on and I want to reinforce here is what is not misallocation? Well, if there's TFPR dispersion due to measurement error, I wouldn't call that misallocation. That's just bad data. If there's unavoidable adjustment cost and transportation cost, that's not misallocation either. If there's things like a high rate of return to one type of capital or one firm's investments, but that's because it has high systematic risk, then that's not necessarily misallocation either. So the planner doesn't want perfect equalization of these TFPR levels because of things like obviously measurement error, but also adjustment cost, transportation cost, differential risk. And you can also think this is something where there's a lot of people have worked on this already. This is actually a rather unexploited area, which is a lot of dispersion in the value of the marginal product of labor across firms or occupations could reflect amenities and disamenities. So what might look like misallocation might be an efficient response to these amenities. And of course, one of the key things is as soon as you write down a production function, you're taking a stand on backing out the wedges. So any mistake you make there is going to flow into your wedge implied misallocation. So that could be a source. For example, if you said, hey, everybody's got the same production function, so any differences in capital labor ratios are inefficient in misallocation, that's clearly vulnerable or susceptible to, wait a minute, maybe the firms just have different production technology. So some have much higher capital labor ratios, but there's nothing inefficient about that. Okay, so the kind of things that, what are these wedges? What kind of things do people think are out there and have been trying to measure them directly? Well, there are tax rate differences in subsidies. So for example, tax rate differences across US states, but also across different size of firms. Often the bigger firms have higher tax rates than smaller firms, certainly than informal firms. And you have things in the US like, contrary to the pollution example, where we should be probably taxing carbon polluters, instead we have things like especially low tax rates and tax breaks for oil and gas firms. A lot of countries have size-dependent regulations, meaning there's things like firing restrictions on bigger firms. So that would lead them to not hire, not fire in a way that might generate dispersion in the value of the marginal product of labor and generate some misallocation. But one thing I want to emphasize is that these are like government failures potentially. They could be internalizing market failures, so they might not be, but they could be government failures. But you can have a lot of private market failures too. So there's things like financial frictions and efficiency wages, but there's growing interest in markup dispersion, but also in dispersion in monopsony power of firms that might lead to misallocation of labor. So in the same way that a high price markup firm, it's like a monopolist. They're raising their price and reducing their output. They don't have enough output and enough inputs relative to what the planner wants. The same thing is true if you have a firm with a lot of monopsony power. They can see that if they want more workers, they have to pay more wages because they're such a big player. So that means they're facing a high marginal cost of labor compared to their wage. So they employ too few workers. So firms with a lot of market power, even in the output side or in the input side, are generally too small, and that's leading to misallocation. Okay. Discrimination is a potential source of misallocation. You can picture it in the labor market, but in many other markets. Already touched on financial frictions. You can picture state-owned banks giving preferential loans to state-owned firms or maybe politically connected firms. People have documented that in various places. You can think of, this is an example of a market failure. You can think of information frictions leading to efficiency wages, and the government could conceivably improve on that if it knows some industries have big efficiency wages relative to others. Then the implication is that they're not employing enough workers and they should be subsidized. I think I'll skip now because I want to make sure I have enough time at the end for some questions before I go from one of my topics to another, but the misallocation concepts to misallocation facts. This one, I was going to emphasize misallocation of talent. The misallocation, even though my examples have been very focused on a firm or a product or a plant, you can think about like allocation of workers across occupations. I think I'll leave this for Chad because Chad's going to talk about this a little bit. But suffice it to say, there's been big changes in the allocation of, say, white men, white women, black women across high-skilled occupations that arguably reflects declining discrimination. But there's a lot of misallocation in the fact that these fractions weren't equal because the distributions of talent were equal across are always been equal across these groups. So any difference here is reflecting misallocation. There's still some, but there's less. But that's an example of a different type of misallocation that could exist and could still exist United States and elsewhere in a way that's leading to too little output, too little innovation relative to what you'd get in an efficient allocation. Okay, these are just kind of generalizations to multiple inputs. So I think I'm going to stop there and make sure I have some time to get some reactions and comments from you all.